Fed up, the bond market is a bit rattled following the Federal Reserve monetary policy meeting. Good morning everyone and welcome back to the last morning markets of the year. And it follows the interest rate decision from the Federal Reserve yesterday evening, and it wasn't great for markets. So the Federal Reserve cut interest rates again for the third time this year by 25 basis points, taking the cumulative cut for the year to 100 basis points, and that's lowered the policy rate in the US to around about 4.5%. The difficulty for markets was the material revision to the forecast for 12 months ahead. Only in September, the Federal Reserve expected another 100 basis points for the next 12 months. They revised that to only 50 basis points. Now, somewhat bizarrely, that actually matched the market's forecast prior to the meeting for just that 50 basis points on a 12-month rolling basis. However, this slightly hawkish revision rippled through markets with bond yields rising materially, but also this fed straight through into equity markets with the S&P 500 having its worst day since COVID back in March 2020. So why the negative reaction? Well, it's probably more to do with the fact that markets around this time of year are very illiquid. There aren't the same volume of trades going through the market and the same depth of market participants just 1 week before Christmas as is normal. And so that thinner liquidity fed into a larger drawdown for equities than perhaps we could have expected. If we look just beyond the inflation forecast, not much has changed. The Federal Reserve still expect a modest rise in unemployment. They still expect inflation to come down next year. It's just less than they had anticipated 6 weeks ago. And that really just reflects what the US faces, which isn't an inflation problem, it's more of a housing problem. Underlying inflation in the US is actually quite benign. It's below 2%, and it's really around the average of the pre-COVID era. It's just that because of the distortions from the pandemic, the US has a rental inflation problem, much like we have in the UK, where rental inflation for the year past has just come in around about 8%. And this is really feeding into core measures of US inflation, in particular in the services bucket rather. So what can the Fed do about it? Not much, just rather guide markets to a slightly less modest policy rate for the year ahead. So it's a thinner period, but the markets still remain very bullish for the year ahead, and they're likely adjusting to the Monetary Policy Committee, probably reflecting less optimistic outlook come January for the direction of policy rates. However, their bias is still toward lower interest rates because Chair Powell did reflect that they do expect further weakening in the jobs market. And that means if we do see any softness in inflation in Q1, then the market is likely to bring forward expectations for that next interest rate cut to March. And if there are material downside misses in inflation, then the market will just simply undo much of the moves it did yesterday and bring forward material interest rate cuts for the first half of next year. So we can see there is a bias in expectations from markets, and the bar for any interest rate hike is much, much higher than the bar for interest rate cut. The Fed are very much in an easing mode. It's just that they really do need to see inflation decline from 2.8% today towards 2.5%, where it hasn't been since before the pandemic. So we're likely biased towards further interest rate cuts. The Federal Reserve are prepared to do that. They just need inflation to be well behaved through Q1. So that's all for today. Please do take care and please do have a great Christmas, and we look forward to speaking with you all in the new year. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.